All right, welcome everyone to today's special edition of the Daily Macro Update for Wednesday, July 30th. We're going to be doing a live analysis of the FOMC press conference for the July Fed meeting with the remarks from Fed Chair Jerome Powell when the people ask him questions that really it doesn't really make sense why they even do it, because why even risk saying something that you're not supposed to say and making the market sell off or whatever. But the reason why they have it is so that they can show face on TV and drive the illusion that they are for the American people. And it's just complete theater. And so they use a lot of bank terminology. So we'll be going through and doing a live analysis as well as market reaction on what Jerome Powell is actually saying, as well as try and translate a lot of what they're saying into English regular people terms. All right. So if you guys have any type of questions, leave those in the comments below, and we'll go ahead. We have about 15 minutes until the actual press conference begins. Until then, we'll go over some of the different things that I'm seeing in the markets here. All right, so the big thing that we were talking about yesterday is this large move in the dollar, right? So for those that don't know, the dollar has officially changed trend from bearish in our model to neutral. Now, this is a huge deal because the dollar is something that is tied to all asset classes, and it's one of the most important macro trends to get right. All right, so that's a huge development there. And then also as well, take a look at oil. Oil is also having a large spike here, and it's also in bullish trend. So, that is pretty interesting there. Gold doesn't like that too much. Bitcoin doesn't like that too much. And for whatever reason, the S&P 500 doesn't care. So that is interesting there. We are having a little bit of a spike in volatility with all of this going on. So with that being the market setup, let's take a look at something interesting here. So this is actually the FOMC statement from June, the last meeting. And what's interesting is that although it looks like they're using a lot of the same words, by the way, the Fed said that they're going to pause rates, which was pretty obvious. Taking a look at this here, there are a little bit differences here in the two statements, right? So between the June meeting and this meeting, the statement changes are about economic activity. So in this one, they're saying that the economic outlook, uncertainty about the economic outlook remains elevated. And in the June statement, they said that uncertainty about the economic outlook has diminished but remains elevated. So they left out the word diminished. And then also as well, when taking a look at, let me see here. Yeah, so economic activity changed from continued to expand at a solid pace to moderated in the first half. All right, so yeah, taking a look at the growth of economic activity, actively moderated for the first half of the year, which means slowed down, right? That's what moderated means. Whereas back in the June statement, it said that recent economic indicators suggest that it has been expanding at a solid pace. So that has been a huge trend shift from what they said last time, right? So, so essentially they're saying economic activity has been slowing down. That's been the big change here. Obviously, also today we received the new GDP number, right? So this expanded at 3% for Q2. Now, this is mainly because of the moderation or the normalization in imports, which we'll get into here in a second, because you want to make sure that you're actually paying attention to the most important aspects of the GDP print, which really is made up of services, discretionary spending, so durable goods, as well as capital investments, so equipment expenditures. And so we'll get into that as well. But yeah, so this actual acceleration in the Q2 GDP number, really it wasn't as impressive as originally thought. We can actually go to my X page here real quick. I did a little bit of a quick tweet. Let me see here. Yeah, so in taking a look at the three best, components that essentially make up around 70% of the entire GDP number, you can see with services, equipment, and durable goods, all three of those came in well below the 1-year average. And so even though you had a large whipsaw effect in both equipment investment as well as durable goods, if you just take a look at the 1-year trend, all three of them came in lower than average. So that's what they're looking at there. What else did we have today? We also had the quarterly refunding announcement from the Treasury Department for 10-year Treasury bonds. And it's pretty much more of the same, right? Really what's happening is they decided to continue with front-loading, bill issuance instead of bond issuance, right? So they're avoiding terming out the debt. Meaning that they're going to continue doing their shadow QE, right? And they're also doing buybacks as well. So if you go ahead and read through this, you can read all about their buyback program. And so here's what's happening essentially. The government is doing shadow QE. They are easing like crazy and avoiding any type of pain by issuing short-term debt, because if they issue long-term debt at these high rates, then they're locking in those high rates, and that's not good, right? And so, so they're choosing to continue to issue Treasury bills at the short end, which is a temporary Band-Aid and is acting like, liquidity flooding the market, which is why asset prices are up so much. But this is only a temporary Band-Aid, because at some point it's going to be a lot harder to keep rolling over this short-term debt if the Fed keeps rates as high as they are. This is why Trump, as well as Bessent, rather than the Fed, keep pressuring Jerome Powell to lower rates, but they can't, because this is a perpetual cycle that we've been doing since 2023, where the Fed keeps rates higher for longer. The government then prints more money at the short end, which floods asset prices and keeps prices stickier, which then causes the Fed to remain, where they're at. And so this loop is going to continue until, something breaks in the markets. And so that will happen at some point. The only thing that you really need to pay attention to for warning signs on that is the 10-year U.S. government bond yield, which has pretty much, ever since November of this year, has been bouncing between, 4.55% and 4.13%. And as soon as it gets down to this lower bound here, then it starts to price in inflation reaccelerating, which gets it back up. And then once it gets this upper bound here, it starts to price in growth slowing. And so it brings it back down. And so we've pretty much been doing this stagflationary ping pong with the U.S. 10-year government bond yield. And again, this will continue until something breaks, and you can expect higher asset prices until that happens. Now, I'm in the camp that we're going to see a huge spike in the U.S. 10-year government bond yield at some point, unless we go into a full-blown recession, in which case, whichever way it breaks out, that will not be good for asset prices. That is definitely coming. And the reason why I can say that it's coming is because when you take a look at U.S. Treasury issuance, you can see that Treasury bills, ever since the peak back in October of 2024, right? So this is bill issuance, what we just talked about. This has been putting in lower highs and lower lows. And right now in June of 2025, we're about to get the new number here coming out in a couple days. But this was the lowest amount of bill issuance since September of 2023. And so as you can see here, this is a trend that's going, downward. And so if the amount of bill issuance is decreasing, then this is a pretty much a canary in the coal mine, signaling that they can no longer keep issuing bills at the level that they're doing, and at some point they're going to have to start terming out the debt. And if the rates are still as high as they are, that is not going to be good, which is why I am paying attention to the 10-year U.S. government bond yield, right? All right, we have about 5 minutes left here. Let's see, what else did I want to go over? We got ADP jobs numbers. That had a nice rebound from the previous negative month. So, there's not really any scare from the jobs market, even though it has been softening significantly. There's not really any type of scare impulse at this moment. We still have jobs numbers coming out on Friday, so we'll see what happens there. And then also as well, today we have earnings after hours for Microsoft and Meta, two of the largest companies in the Magnificent Seven stocks. That'll happen tonight after hours. And then tomorrow we have Apple and Amazon. So 4 out of the largest Mag 7 stocks are reporting this week. That's what is also coming down the pike here. So lots of interesting information there. All right. So let's go ahead and dive into the GDP numbers here for the next 4 minutes until we end up having Powell come on here and tell us usually what we already know, but looking forward to the questions there. So when you go to the BEA.gov website, right, the Bureau of Economic Analysis, and you go to the GDP print here, this page does give you a good amount of information, but as you can see, there's a large decrease in imports, right? And so there's a large decrease in investments, right? There's a lot of investments that were made during the prior quarter, and all of this was in anticipation of tariffs, right? So tariffs was really the one that caused this crazy whipsaw. If you take the average between the two GDP prints so far in 2025, it's a 1.25% growth rate, which is a lot lower than last year, right? And so that's in line with the Conference Board's estimate as well. But on this website here, what I use whenever this comes out is I go to Tools and I go to Interactive Data, and then I go to GDP, Gross Domestic Product, click on the Interactive Data tables here, and then that will bring us to this one. You go to Section 1 for Domestic Product, and then you go to Table 1.1.1. Click on that there, go to Chart, do Bar Chart. And so, if you click on Gross Domestic Product, you'll see that here. But again, we want to break this up into its most important components, right? So you want to do personal consumption expenditures, gross domestic investment, or actually we'll do fixed investment, exports, imports, and government expenditures. Now let's get rid of imports because this crazy whipsaw the past 2 quarters has really distorted the numbers. So let's get rid of that. We'll just get rid of trade in general. And then within the fixed investment, the most important one is equipment in terms of leading indicators. Let's get rid of government because it does have a decent chunk of GDP, but we just want to see what is going on with the real economy, right? Government isn't necessarily the most important one. We'll do durable goods and services for PCE. That way we get a better understanding here. And so if we just go back and look at the past year here, it's about to start. You can see that really, a weak amount of each one of these different things, right? And so, I am in agreement with the Fed that growth is softening. And so, I don't think that this was a great GDP number, despite what a lot of you're going to see on the mainstream media. All right, so it's just starting here. Let me remove this. 1 second. All right. Let me just blow this up a little bit more so that everyone can see it. There we go. Purple tie. I can't put the screen on, by the way.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people.
Wrong.
Despite elevated uncertainty, the economy is in a solid position. The unemployment rate remains low, and the labor market is at or near maximum employment. Inflation has been running somewhat above our 2% longer run objective. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. We believe that the current stance of monetary policy leaves us well positioned to respond in a timely way to potential economic developments. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that growth of economic activity has moderated. GDP rose at a 1.2% pace in the first half of this year, down from 2.5% last year.
See? Yep.
Although the increase in the second quarter was stronger at 3%, focusing on the first half of the year helps smooth through the volatility in the quarterly figures related to the unusual swings in net exports. The moderation in growth largely reflects a slowdown in consumer spending. In contrast, business investment in equipment and intangibles picked up from last year's pace. Activity in the housing sector remains weak. In the labor market, conditions have remained solid. Payroll job gains averaged 150,000 per month over the past 3 months.
Most of it
the unemployment
government.
rate at 4.1% remains low and has stayed in a narrow range over the past year.
The gig economy is distorting that number.
Wage growth has continued to moderate while still outpacing inflation. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance and consistent with maximum employment. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer run goal.
Somewhat.
Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in June, and that, excluding the volatile food and energy categories, core PCE prices rose 2.7%. These readings are little changed from the beginning of the year, although the underlying composition of price changes has shifted. Services inflation has continued to ease, while increased tariffs are pushing up prices in some categories of goods.
Blame Trump.
Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market-based and survey-based measures. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting,
Only
the
rich
committee
American
decided to
people.
maintain the target range for the federal funds rate at 4.25% to 4.5%, and to continue reducing the size of our balance sheet.
They're
We will
gonna keep
continue to
doing
determine
QT.
the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. Changes to government policies continue to evolve, and their effects on the economy remain uncertain. Higher tariffs have begun to show through more clearly to prices of some goods, but their overall effects on economic activity and inflation remain to be seen. A reasonable base case is that the effects on inflation could be short-lived, reflecting a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to keep longer-term inflation expectations well anchored and to prevent a one-time increase in the price level from becoming an ongoing inflation problem. For the time being, we're well positioned to learn more about the likely course of the economy and the evolving balance of risks.
Really
before adjusting
focusing
our
on
policy
inflation.
stance. We see our current policy stance as appropriate to guard against inflation risks. We're also attentive to risks on the employment side of our mandate. In coming months, we will receive a good amount of data that will help inform our assessment of the balance of risks and the appropriate setting of the federal funds rate. At this meeting, the committee continued its discussions as part of our 5-year review of our monetary policy framework. We focused on potential revisions to our statement on longer-run goals and monetary policy strategy, and are on track to wrap up any modifications by late summer. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thanks, Chair Powell. There's a lot of lean in the markets, and not to mention out of the administration for a rate cut now in September. Is that expectation unrealistic at this point?
So, as you know, today we decided to leave our policy rate where it's been, where I would characterize as modestly restrictive. Inflation is running a bit above 2%, as I mentioned, even excluding tariff effects. The labor market's solid, historically low unemployment. Financial conditions are accommodative, and the economy is not performing as though restrictive policy were holding it back inappropriately. So it seems to me and to almost the whole committee that the economy is not performing as though restrictive policy is holding it back inappropriately, and modestly restrictive policy seems appropriate. All that said, there's also downside risk to the labor market. In coming months, we'll receive a good amount of data that will help inform our assessment of the balance of risks and the appropriate setting of the federal funds rate.
So just to follow up,
Looks like you answered that right off of a prompt.
Does that include the possibility you'll be getting essentially 2 rounds of jobs and inflation data between now and the September meeting? Is that potentially adequate to make a decision to lower rates at that point?
So you're right. We do have, this is an intermeeting period when we'll get 2 full rounds of employment and inflation data before the time of the September meeting. We have made no decisions about September. We don't do that in advance. We'll be taking that information into consideration and all the other information we get as we make our decision at the September meeting.
Steve.
Thank you, Mr. Chairman. You took out the
Didn't
word,
even answer the question.
or the notion that uncertainty has diminished from this statement. Does that mean uncertainty has increased? And I'm just wondering, the administration has struck several deals with large trading partners where it seems like we now know what the rate is going to be. Does knowing that rate add to your certainty to change policy, or do you need to
No,
wait
he
to
needs
see
to see
the
actual
economic
data.
effects?
They're delayed.
So
Dumb question.
essentially the statement in our statement about uncertainty reflects what's gone on since the last meeting. So at the time of the last meeting, uncertainty had moved down a little bit, but it was more or less even this time. So we took out, had diminished because it didn't diminish further. So there's not really much in that. And then your second question is, say again?
There have been several deals that have been struck, and now we seem to have an idea of what the tariff rates are going to be with some of our large trading partners. Does that not add to the kind of certainty you might need?
No,
or
we're
is
going to
it
wait for
you're
the real
waiting for
data
the
to come in,
economic
blah, blah, blah.
effects to show themselves?
No, I think we're still, you're right, it's been a very dynamic time for these trade negotiations, and lots and lots of events in the intermeeting period, but we're still a ways away from seeing where things settle down. We are clearly getting more and more information, and I think at this point, people's estimates, our estimates, outside estimates of the likely effective level of tariffs is not moving around that much at this point. But at the same time, there are many uncertainties left to resolve. So yes, we are learning more and more. It doesn't feel like we're very close to the end of that process, and that's not for us to judge. But it feels like there's much more to come, as well, looking ahead.
Neil.
Hi, Mr. Chairman. Neil Irwin with Axios. This morning, we got a GDP report in which final domestic private purchases decelerated, slowest pace since 22. There was a weakness in the interest-sensitive sectors and residential investment, commercial structures. Are those not signs that monetary policy is a little too restrictive right now, given current economic conditions?
So the GDP and
No, because
PDFP numbers
inflation.
came in pretty much right where we expected them to come in. You got to look at the whole picture. So certainly, as I mentioned in my opening remarks, economic activity data, GDP, private domestic final purchases, which we think is a narrower but better signal for future, for where the economy is going, has come down to a little better than 1%, 1.2%, I think, in the case of GDP for the first half, whereas it was 2.5% last year. So that has certainly come down. But if you look at the labor market, what you see is, by many, many statistics, the labor market is kind of still in balance. It's things like quits, job openings, and let alone the unemployment rate. They're all by many measures, very similar to where they were a year ago. So you do not see weakening in the labor market. You do see a slowing in job creation, but also in a slowing in the supply of workers. So you've got a labor market that's in balance, albeit partially because both demand and supply for workers is coming down at the same pace, and that's why the unemployment rate has remained roughly stable, which is why I said we do see downside risk in the labor market. I mean, our two mandate variables, right, are inflation and maximum employment.
Yeah, so he's
Stable
talking
prices
about
and
people
maximum
moving
employment,
out of
not so much
unemployment
growth.
to out of the workforce, which
the labor market
that'll bring down the
looks
unemployment rate,
solid.
but that's still
Inflation
not a
is
sign
above
of
target,
strength
and
within the
even
labor market.
If you look through the tariff effects, we
Discouraged
think it's still a
workers
bit
is not
above
good.
target, and that's why our stance is where it is. But as I mentioned, downside risks to the labor market are certainly apparent.
So on labor, given the fluid labor supply situation, is there a number for this jobs report we get on Friday that would look to you like equilibrium job growth?
The main number you have to look at now is the unemployment rate, because it's true that
Which is
demand
the most
for
lagging
workers in the
indicator
form of,
that
let's
you can
call it,
have.
just say payroll jobs, that number has come
Whoever
down, but
thinks
so
the
has
Fed is gonna
break-even number,
proactively
kind
cut
of in
rates,
tandem. So
good luck.
as long as that puts the labor market in balance. The fact that it's getting into balance due to declines in both supply and demand, though, I think it is suggestive of downside risk. So we of course, will be watching that carefully.
Colby.
Thank you. Colby Smith with the New York Times. Two of your colleagues called for a quarter-point cut today, and I'm wondering what aspects of their argument were most compelling to you and how you're weighing their views against those on the committee who, as of the June forecast, were in the camp of the Fed holding interest rates steady for the remainder of the year. And just in terms of the June SEP in particular, is that still the best representation of where the core of the committee is?
So on the dissents, what you want from everybody and also from a dissenter is a clear explanation of what your thinking is and what are the arguments you're making, and we had that today. So I think basically this was quite a good meeting all around the table where people were thought carefully about this and put their positions out there. As I mentioned, the sort of the majority of the committee was of the view that inflation's a bit above target, maximum employment is at target. That calls for modestly restrictive, in my way of thinking, modestly restrictive stance of policy for now. But we had two dissenters who I think, you want that clear thinking and expression of your thinking, and we certainly had that today, I think all around the table. In terms of, you asked about the June SEP, I wouldn't, that you're right, that's what it says, and that may well, I couldn't point to it 6 weeks later as expressing people's thought. You really can't do that. We don't run an SEP, and I don't like to substitute in my own estimate of what the SEP might be. We don't have one. So I'll just say that, we haven't made any decisions about September. We'll be monitoring all the incoming data and asking ourselves whether the federal funds rate is in the right place.
And just on the point about policy being only modestly restrictive, does that mean that there's actually not much scope to reduce rates once the conditions for a cut are met, barring a significant weakening of the labor market?
So let me say, my own estimate is modestly restrictive, and there are a range of views of what the neutral rate is at this moment.
Someone
for
was
our
just
economy,
DMing
and
me
so
about the
others may
neutral
say
rate.
it's
Nobody
more
knows what it
restrictive or
is.
less
It's a made-up
restrictive
number.
even. We're going to be at some point, when we return to moving toward a more neutral stance, we'll be making that judgment as we go. I don't think we have a preset course. It's not so mechanical as saying, you know, we've derived with great confidence the neutral rate and that is our destination, because really we understand that no one actually knows what the neutral rate is. We
There
know
you
it
go.
by its works. And that will be how the way the economy reacts over time to, you know, to slightly looser policy.
Nick.
Nick Timmeros, The Wall Street Journal. Chair Powell, my question is about what have you learned over the last few months about the inflation generating and price pass-through process? And just to drill down, the June CPI report showed evidence of tariff-induced goods inflation. Now, the tariff landscape is only starting to be settled with some of these more recent deals. Given the lags between when tariffs are announced and when they show up in goods prices, is 2 months a long enough horizon to evaluate the impact and be confident that tariffs aren't impacting the broader inflation process?
I think you have to think of this as still quite early days. And so I think what we're seeing now is substantial amounts of tariff revenue being collected on the order of $30 billion a month, which is, you know, substantially higher than before. And the evidence seems to be mostly not paid only to a small extent through exporters lowering their price, and companies or retailers, sort of people who are upstream, institutions that are upstream from the consumer, are paying most of this for now. Consumers it's starting to show up in consumer prices, as you know, in the June report. We expect to see more of that. And we know from surveys that companies feel that they have every intention of putting this through the
prices.
consumer, but you know, the truth is they may not be able to in many cases. So I think we're just going to have to watch and learn empirically how much of this and over what period of time. I think we've learned that the process will
They are
probably
in
be
no
slower
rush, ladies and
than,
gentlemen. No
than
rush to
expected
cut.
at the beginning, but we never expected it to be fast.
So what, Norm Ray is
And
92. Is this
we
good
think
for
we have a long
crypto?
way to go to really understand exactly how it will be.
Well, monetary
that's how we're
policy is just
thinking of
one
it right
side
now.
of the question.
So if I could follow up,
The
is
government's
the
still
reticence to
printing,
look
so,
through core
yeah,
goods
it is good for
inflation being
crypto.
driven by the judgment that during the pandemic, expectations proved more adaptive than anyone at the Fed expected?
At some point it won't,
driven
though.
by uncertainty over how restrictive policy is?
You could argue we are a bit looking through goods inflation by not raising rates. You know, we haven't reacted to new inflation, but I mean, I wouldn't insist upon that, but I don't think.
So he's not gonna
I
raise
think
rates.
The base case, as I said, a reasonable base case is that these are one-time.
Uh-oh, I don't think you meant to say
one-time
that.
price effects. Of course, in the end, there will not be. This will not turn out to be inflation, because we'll make sure that it's not. We will through
The
our tools
S&P
make sure that this does
500
not
is
move from
giving up
being
most of the
a
gains from this
one-time price
morning.
increase to serious inflation. We want to do that efficiently, though, and that means we want to do it. If you move too soon, you wind up maybe not getting inflation all the way fixed, and you have to come back. That's inefficient. If you move too late, you might do unnecessary damage to the labor market. So there won't be, in the end, a big inflationary problem. What we're trying to do is accomplish that in a way that is efficient. But in the end, there should be no doubt that we will do what we need to do to keep inflation under control. Ideally, we do it efficiently.
Michael McKee from Bloomberg Television and Radio. The one big bill, leaving aside the adjectives, do you expect it to add stimulus to the economy in 2026? And would that be an argument for remaining on hold or cutting back on the number of rate cuts you would expect for next year?
So, of course, let me just ritual disclaimer that we don't express any judgments or anything like that on fiscal legislation or other legislation for that matter. But I would say when you think that, you know, the biggest part of the bill was making permanent existing law on taxes, I don't think we see it as particularly stimulative. There should be some stimulative effect, but it shouldn't be significant over the next couple of years.
And to follow
Tariffs
up,
are a tax, people.
What do you, well, I don't want to put this
It's
in
an
terms
indirect
of you
tax
and
on the
president,
American
so
people.
Let me ask it this way.
Instead of just raising your
Do you
taxes
have
on your
concerns
paycheck,
about
tariffs
the
raise your
cost to
taxes
the government of
in an
keeping
indirect
rates
way.
elevated for longer in terms of interest rate charges?
Yeah, no, that's, we have a mandate, and that's maximum employment and price stability. And it is, it's not something we do to consider the cost to the government.
Bitcoin is selling off a bit.
Rate changes. We have to be able to look at the goal variables Congress has given us, use the
116,800.
tools they've given us to achieve those goals, and that's what we do. We don't consider the fiscal needs of the federal government. No advanced economy central bank does that, and it wouldn't be good for, if we did do that, it would be good neither for our credibility nor for the credibility of U.S. fiscal policy. So it's just not something we take into consideration.
Victoria.
Hi, Victoria Guida with Politico. When it comes to the renovations of the Federal Reserve's headquarters that the
Oh, boy.
administration has been looking into, do you see their interest in that issue as being directly tied to the president's push to get you to lower interest rates?
Not for me to say. I will say we had a nice visit with the president. It was an honor to host him. It's not something that happens very often at the Federal Reserve to have the president come over, let alone to visit a building. But it was a good visit.
Are there any aspects of the project that they've raised that you see as making you reconsider any aspects of the project?
So, this project was hatched and conceived almost a decade ago now, and we went through the very long process of clearing it through historic preservation at the National Capital Planning Commission, and a lot of back and forth there. It was very constructive. We started out to do the work, and we're very well along on that work, and I was quite pleased to have the president say multiple times that what he really wanted to see was us getting this construction completed as soon as possible. That is our focus, and that's what we're going to do.
Andrew.
The dollar is pumping.
Thanks, Mr. Chairman. Andrew Ackerman with the Washington Post. What message do you take from the fact that inflation hit 2.1% last September?
Yield curve
and
is
has bounced
flattening.
higher since. Why do you think
Two-year
financial
yield is
conditions are
surging.
restrictive and a neutral rate's below 4% when inflation has stopped falling for almost a year?
This is being considered as a
So
hawkish
inflation,
FOMC.
When you talk about these 12-month inflation measures, you're always battling residual seasonality. So we'll have, for example, 2 months of high inflation sometimes early in the year, and then inflation turns lower, and a lot of that may just be an artifact. So that's why we look at the 12-month numbers. I think inflation is most of the way back to 2%. There are things like the catch-up inflation. So, for example, all the insurance costs that they're only now going through inflation, but they actually reflect inflationary pressures from 2-3 years ago. So that's got to go through. In addition, now we have 3 or 4 tenths of inflation in core inflation from tariffs. So, and we can't really separate that out. We're not going to have a separate kind of inflation that isn't the tariffs. We're always going to be dealing with all of inflation. But the composition, as I mentioned, has really changed. And if you go back to the last couple of years, it was all about services inflation, which was being very sticky. Now services inflation is coming down nicely. Goods inflation was well behaved before, and now goods inflation is going up. So the story has really changed. That's partially because of tariffs. It's also partially because we had restrictive policy in place, and we've seen that the result of that gradually work its way through the services economy.
Okay, the other thing I wanted to ask is, are you comfortable that BLS can continue performing their mission effectively if they take an 8% reduction in headcount and authorized spending as the administration has proposed?
I'm not going to comment on the administration's proposal. I do think, as I've said, I think that we're getting the data that we need to do our jobs, and I think it's really important that good data helps not just the Fed, it helps the government, but it also helps the private sector. People in the economy, they use this data a lot too. So it's quite important for our economy, and certainly for the Fed's work and other government agencies' work, that we continue to get better at data. That's what we've been doing for 100 years. We've been getting better and better and better. It's very hard to accurately capture in real time
after a
the output
catastrophe,
of a
after a catastrophe,
$20+ trillion
after a catastrophe.
economy. And the United States has been a leader in that for 100 years, and we really need to continue that, in my view.
Edward.
Bitcoin really having a decent sell-off,
Thank you,
along
Mr.
with
Chairman. Edward
gold.
Lawrence from Fox Business. How concerned are you with the data that we're showing coming in, showing no significant upward trend?
Gold is
in
down
inflation over the past 6
128
months, that
basis
the wait and
points.
see
Wow.
approach for inflation is actually giving companies cover to raise prices?
How concerned am I that say that again?
The wait and see approach is
The
giving.
wait and see approach, what do you mean by that?
For cutting rates. You're waiting to see if the tariffs will affect inflation. So it's a wait and see approach.
Well, so
sort of
that, that's where policy's restrictive. When we start cutting it, it'll go toward neutral.
Okay, this delay, though, where you're saying there's a one-time price increase for tariffs, which possibly could lead into bigger inflation or more inflation. Is that giving companies cover, though, to raise prices?
Well, what may be giving, it's not our policy stance, what may be giving, some companies will certainly be taking advantage of the fact of the tariffs and all the discussion of how they're going to, companies will raise prices when and as they can.
Will the background
And
light
you
turn
saw it
red?
famously
It would take a lot
in the
to
first
do that at
administration
this
of
point.
President Trump. During those tariffs, washing machines were tariffed, but dryers weren't. But what do you know? The price of dryers went up too, just like washing machines. So companies will often they'll cross the street in a group, if you know what I mean. That'll happen. We don't see a lot of that. I mean, what we see now is basically the very beginnings of whatever the effects turn out to be on goods inflation. And I'll say again, they may be less than people estimate or more than people estimate. They're not going to be zero. Consumers will pay some of this. Businesses will pay some of this. Retailers will pay some of this. But we're just going to have to see it through.
And just to follow, if I could, some additional tariffs have been in place since February, and things really haven't broken yet with the economy. So how do you justify to somebody who's looking for a house, who's facing a 7% mortgage and maybe can't afford those rates? How do you justify that?
Well, so the housing is a special case, right? We don't set mortgage rates at the Fed, right? We set an overnight rate, and the rates that go into mortgages are longer term rates, like Treasury rates. It might be 30-year rates, it might be shorter than that, but it's not the overnight Fed's rate. It's not that we don't have any effect. We do have an effect, but we're not the main effect.
Yep.
There are other things going on in the housing sector, and one of those is just there's kind of a long-term housing shortage that we have. We haven't built enough housing. This is not something the Fed can help with, and that'll be the case even after things normalize. So I think the best thing that we can do for housing is to have 2% inflation and maximum employment, and that's what we can contribute to housing. There are lots of other jobs to do for the private sector and Congress, but that's what we're trying to get to. I mean, we've made a lot of progress toward that. We have a very good labor market right now. Inflation, we were very close
There
to 2%.
actually is enough
We're
supply.
seeing some goods inflation
And
move
supply
us away, but
continues to
so far not
rise.
very far away.
However, it's so expensive that people are getting priced out.
Hi, Chair Powell. Thank you. Well, can you give us a little more about what kind of economic data does the Fed need to see before you'll be ready to cut? I mean, do you need inflation back nearly to target? Are there other things in the pricing that you look for?
I need a cut. I
In the
need a
job
cut.
market? What kind of things are you looking for?
These questions are
I
unbearable.
mean, ultimately, it could be any of those things, right? But if you saw that the risks to the two goals were moving into balance, if they were fully in balance, that would imply that you should move toward a more neutral stance of policy. This is the special situation we're in, which is we have two-sided risk to both of our goals. When we paused, inflation was above target and the labor market was pretty good. So that was a time when policy was restrictive when we paused. And to be restrictive is to be supporting a return to our inflation target, right? So as the two targets get back into balance, you would think you'd move in a way closer to neutral, and that the next steps that we take are likely to be in that direction. What will it take? It'll be the totality of the evidence. As I mentioned, there's quite a lot of data coming in, which before the next meeting. Will it be dispositive of that? It's really hard to say. We don't make those decisions right now, so we'll have to see.
Well, I guess just in terms of inflation, though, for example, like will some people would point to if it remains only in goods and it doesn't bleed over to services, then maybe that's evidence that the tariff effect is going to be a temporary one-time thing. Is that kind of thing affect your thinking, or do you just need to see the number come down
I think
closer to 2?
We'll look at everything. You know, it's, as I mentioned, you know, a pretty reasonable base case is that this will be a one-time price increase. And in the end, we'll make sure that that's the case. We're just trying to do that efficiently. And efficiently means getting the timing right so we don't, again, if we cut rates too soon, maybe we didn't finish the job with inflation. History is dotted with examples of that. If you cut too late, then maybe you're doing unnecessary damage to the labor market. So we're trying to get that timing right, and that's effectively what we're doing.
Claire.
Claire Jones, Financial Times. Just a question on the dollar. We've seen it decline quite heavily this year. I was wondering if there's been any discussion about that at the meetings and to what degree that might be complicating your attempts to get inflation back to target. Thank you.
So this goes back to the division of labor between the Fed and the Treasury, as you, I'm sure, know. And, you know, the Treasury only speaks to the dollar. It's not something that's been a topic of you know, major discussion at all at the Fed. I wouldn't say it doesn't come up. If the transcripts, when they come out in a few years, they'll probably reflect some mentions of the dollar, but it would never be a major focus.
And just to follow on, if I may, to Andrew's question, I think the amount of imputed data in CPI now is up to 35%. I mean, is there any discussion of that as well? Is there any consideration of looking at alternative measures, data scraping and so on, in order to just ensure you've got a good read on what's happening to prices in the U.S. economy? Thank you.
You know, we're monitoring the situation. We do, of course.
Oh my gosh,
as you
the
know,
price
during
of
the
copper
pandemic, we
just tanked.
looked at a whole lot of new kinds of data. People are looking
Whoa.
at big data sets that you can get from all sorts of places, and we do all of that. But at the same, we really need the government data. Really is the gold standard in data, and we need it to be, you know, to be good and be able to rely on it. And we're not going to be able to substitute for that, but you know, we'll have to make do with what we have. But I certainly hope that we get what we need.
Jay O'Brien.
Hi, Mr. Chairman. Jay O'Brien, ABC News. President Trump has obviously invoked your name a lot. He has personally pressured you. Are you concerned the way that conduct might impact the Fed's independence going forward?
I'll just say that, so I think that having an independent central bank has been an institutional arrangement that has served the public well. And as long as it serves the public well, it should continue and be respected. If it didn't serve the public well, then it wouldn't be something that we should just automatically defend. But what it gives us and other central banks, what it gives you is the ability to make these very challenging decisions that in ways that are focused on the data and the evolving outlook, the balance of risks and all the things we talk about, and not political factors. And so governments all over the advanced economy world have chosen to put a little bit of distance between direct political control of those decisions and the decision makers. So if you were not to have that, there would be a great temptation, of course, to use interest rates to affect elections, for example. And that's something that we don't want to do. So I think that's pretty widely understood. Certainly it is in Congress. And I think it's very important. I'll just say that.
Maria Eloisa.
Afternoon, Sir Powell. Maria Luisa Capurro from Bloomberg News. You mentioned a slowdown in consumer spending, and I wanted to see if you could walk us through what was the discussion with the committee around that. We've seen delinquency rates rising for upper income households. How do you see that evolving in the next few months, and how much of a vulnerability that is for the economy going forward?
Consumer spending had been very, very strong for the last couple of years, and had repeatedly, forecasters, not just us, had been forecasting it would slow down, and now maybe it finally has. So I would say if you talk to credit card companies, for example, they will tell you that the consumer's in solid shape and that spending is at a healthy level. It's not growing rapidly, but it's at a healthy level, and delinquencies are not a problem. You mentioned high-end delinquencies. I don't know what to make of that. I read the same thing. But so generally, and if you look at the banks, and when the banks talk about in their earnings calls, the performance of credit has been good. So essentially, you have a consumer that's in good shape and is spending, not at a rapid rate, but
Whenever he
it's true,
says
and it's,
consumer,
again, right in line with what we expected.
that means the wealthy consumer.
The GDP data that we got this week. And I think it's still a little bit difficult to interpret because you have these massive swings in net exports, which may also be affecting, some of that can be can affect consumer spending as well. Look, it's one of the data points that we pay most careful attention to, and there's no question that it's slowed. And we're watching it closely, but we also watch the labor market and the performance of inflation. Those are our two variables that we're assigned to maximize.
And just to follow up on what my colleagues were asking about this sense, Governor Waller said that the labor market
Cryptocurrencies are
is
selling
on
off right
edge,
now.
and he was pointing to weaknesses on the private sector. I was wondering, you said that the main number to look at is the unemployment number overall, but what was the discussion about the state of the private jobs market?
So I'm not going to talk about any individual's, any individual's comments. I wouldn't do that. But I think what we know is that
The dollar is ripping.
private sector job creation, certainly in the last report, we'll see on Friday, but had come down a bit. And if you take the QCEW adjustment seriously, it may be even lower, maybe close to zero. But the unemployment rate was still low. So what that's telling you is that demand for workers is slowing, but so is the supply. So it's in balance, oddly enough. You've got a very low unemployment rate, and it's kind of been there for a year as job creation has moved down. But also we know that because of immigration policy, really, the flow into our labor force is just a great deal slower, and those two things have slowed more or less in tandem. If you look at things like I mentioned, quits, look at wages. Wages are gradually cooling. Look at vacancies to unemployment. Those things have been pretty stable they haven't really moved a lot in a full year. So I think if you take the totality of the labor market data, you've got a solid labor market. But I think you have to see that there are downside risks. You don't see weakening in the labor market, but I think you've got downside risks in a world where unemployment's being held down because both demand and supply are declining.
Yeah, copper definitely broke trend to bearish
and we
on
are.
that.
Nancy.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. One more question on the lack of unanimity in today's decision, the two dissents. Was there talk during the meeting? I know you're not going to talk about exactly what individuals said, but in general, was there talk during the meeting of cutting rates, and what was the case against that?
No, there
at
wasn't.
the meeting?
What a dumb
Sure.
question.
So, we have an economic go-around where people talk about the economy, and then that's yesterday, and then today we have a monetary policy go-around. All the way around the table, everyone gives their views. So the discussion around policy was, the majority view was still what it has been, which is that inflation's running above target, maximum employment is right at target. That means policy should be a little bit restrictive, somewhat restrictive, because we want inflation to move all the way back to its target. So that's where people have been and still are. Two of our members felt that the time had come to cut, and that they, for the reasons that they're going to express, I won't tell you the reasons they'll issue some kind of a thing in the next day or so. So, but that's the story, and I would say, well argued, very thoughtfully argued all around the table, good arguments, and it's a situation where unusual situation. The economy is in good shape, but it's an unusual situation where you have risks to both your employment mandate and your inflation mandate. That's the nature of a supply shock. And it's probably not surprising that there would be differences and different perspectives on that, as well as different views of where the neutral rate is. So that different views of how tight policy is. So we have those. I will say what you hope is that people, explain their positions very thoughtfully and clearly, and we absolutely had that today, all the way around the table. I would call it one of the better meetings I can recall from that standpoint.
And you
Everyone's
said
hawkish.
You're waiting to be confident inflation is heading toward your 2% target before you start cutting rates. When you do get that confidence, would you be in favor of lowering rates right away?
It's not quite the way I would put it. I said that's why we think policy should be restrictive, is because, inflation is above target. When we have risks to both goals, one of them is farther away from goal than the other, and that's inflation. Maximum employment's at goal. So that means policy should be tight, because tight policy is what brings inflation down. If you came to the view that the risks to the two were more in balance, that would imply that policy shouldn't be restrictive. It should be more neutral, a neutral stance, and that would be somewhat lower than where we are now. No one knows exactly where that is. So that's the framework I think I'd be taking, and we'll just have to see. We're going to be obviously looking at a lot of data in the next cycle. It is one of the cycles where we have 2 employment and 2 inflation reports, and we'll see where that takes us.
Jeff Cox.
Where will it take us, Jay? Into the ground or
Thank
to
you,
the
Mr. Chairman,
moon?
taking the question. Jeff Cox from CNBC.com. A metric that you like to cite a lot is the final sales to private domestic purchasers. That was down to a 1.2% gain in second quarter from 1.9% in Q1, suggesting that there's some softening in underlying demand. I just wondering if you look at that and you combine that with some of the housing numbers, the weakness that you acknowledged at the top of your remarks, that the housing market is in fact weak, and the inflation numbers from GDP today came down to 2.1% for headline, 2.5% for core. I'm wondering how much more movement you would need to see from these data points before you would be comfortable with cutting in, say, September.
It's going to be the total. Hard to answer that specifically. PDFP, I think, for the first half, private domestic final purchases, or final sales, as people call it, was 1.6 on the first half. GDP, I believe, was 1.2%. That's the whole half. You mentioned the quarters. So those are slower, but GDP is bumpy quarter to quarter, half to half, and often gets revised, after the fact. The labor market data we still think continue to think is the best data we have on the economy, and that shows a 4.1% unemployment rate. It shows wages, still at a healthy level, but moving
So it
ever
keeps on
closer
falling
to
back
what we
on
would
a lot of
regard
these
as
lagging
long-run
data
sustainable,
points
consistent with
where
longer-run productivity
if you're
and 2%
just
inflation. So
focused on
the labor market
policy
is
based
actually
off
still quite solid.
the labor market,
Inflation
as
is
well as
above
inflation,
target, even ignoring tariffs.
you're driving
It's
with
a
the
little
rear
bit
view
above
mirror.
target and tariffs. So we're watching all of that, and again, trying to do the right thing in what is a challenging situation, because you're being pulled in 2 directions, and you have to decide which of those to go in. And actually, at some point, if they're sort of equally at risk, then you really want to be at a neutral policy stance, which we're not right now.
So it'd be safe to say that if the data kind of stays in line with where it is right now, that you wouldn't be comfortable with cutting in September?
I'm not gonna say that. No, I just think we're going to need to see the data, and it can go in many different directions. The inflation data and the.
I'm so surprised that the market really thought
we're going to make a judgment
the Fed was
based
going
on
to
all
cut
of the
in
data
July.
and based on that balance of risks analysis that I mentioned.
Thank you.
Greg Robb for the last question.
Thanks, Chair Powell. Greg Robb from MarketWatch. The Treasury Secretary has said recently that it would be confusing for the markets if you stayed on as a governor after your term as chair ends. And I was wondering if you had any update for us on a decision on that front.
Sorry, I do not have any update for you. Thanks very much, everyone.
All right. Well, there you guys have it there. Let me just go ahead and now share the screen over to the dollar here, just to show you the rise in the dollar that we're seeing currently right now. Let me just make this a little bit better for the viewers. All right, so yeah, this dollar trend right now, I mean, it's pushing on almost going bullish. It would need a little bit more time though for this trend, but lots of strength on higher volume for the dollar. What's also interesting is that on this Fed meeting, you also have rates having a rebound. Part of the reason why it had the decline yesterday was because of the refunding announcement today. That typically happens, right before a quarterly refunding announcement. So there's not really too much of a surprise there. Now, even with the volatility that we're seeing right now, or the sell-off, I mean, you still have VIX below 17, right? So I mean, this isn't like, oh my gosh, what's about to happen? You are seeing oil, and then of course the enormous sell-off here in copper. Look at this move. Somebody asked, does this mean that that copper has broken trend? Yeah, a 20% down move is definitely breaking trend. So, so yeah, seeing that, as well as some others here, I wouldn't be putting this in the category of like, straight up panic, right? I mean, look at Bitcoin. It's not having a crazy drawdown. Ethereum having a tiny bit of a correction, but definitely still within a bullish range. So I mean, I just think that the market is just going to try and reprice a lot of its expectations. And look, this is the entire situation that's happening right now. So you have the Fed and the government at odds with each other. And you have the Fed doing QT, as well as keeping rates higher for longer because of inflation concerns, while the government is issuing treasury bills to fund its deficits, which increases over time the likelihood of some type of event happening if rollover risk starts to seriously take hold, right? And, that's a very slow process, because this entire thing with the government doing shadow quantitative easing while the Fed is remaining still, this has put a net positive liquidity in the financial markets, which is why over the past 3.5 years, you've seen quite the impressive run-up in risk on assets. And so the whole thing is that, yes, the can is being kicked, but this cannot last forever unless you want the 10-year, unless you want the bond market to completely revolt against you, right? And so in either case, each one ends up in a hard landing. Now, the magnitude as well as the timing of that is unknown, obviously. We can't predict the future. But at some point, this is going to reach a time where, if it just continues on like this, where the government can no longer keep issuing treasury bills to fund its deficits, and there's going to be rollover risk. And so, I will be, continuously watching these quarterly refunding announcements to see if they start to decrease or continue to decrease the amount of treasury bill issuance, which, again, we've already been seeing that, like I mentioned here. So this is the signal, right? So the series of lower highs and lower lows in bill issuance, this is showing that we're getting close to that point. And again, it's not like that things are going to be bad next week, but the next 12 months, there's a lot of risk. There's a lot of risk that's still not being priced into the markets. And like I mentioned before, at some point, the government will not be able to do their shadow QE as much as they're doing. And as a result, the markets aren't going to like that. And so, we are going to have a correction at some point in the major risk-on environment. I have no doubt about that. But until then, it's really just party on. And then you just heard it from the Fed that they're really not going to. They're not going to cut rates until they see a material decline in growth or inflation, or a very large spike in the unemployment rate. Right? So that's really what's happening here. But yeah, this trend change in the dollar, this is the biggest thing that you can pay attention to right now, right? If you were to have one takeaway from what's happening right now in the macro environment, it's that the dollar's changing trend. What other things can we look at here? That's pretty much it. The Treasury General account has been stuck around 300 billion. The RRP has remained flat since October. Reserves are staying where they're at. So yeah, you're starting to see a little bit of a topping effect on net central bank liquidity at 2 trillion. So yeah, let's go over here. So here's net central bank liquidity. Let's put over our price of the S&P 500. What do you guys see over here? So the S&P 500 is in red, and net central bank liquidity is in orange. That kind of looks familiar, doesn't it? At some points, they have been oppositely correlated. But yeah, when net central bank liquidity starts to go down, that will be an issue. But yeah, that Fed meeting that we just had, very hawkish. That's going to be classified as a hawkish meeting. And yeah, they essentially just reiterated that they're not going to cut rates until something happens. And by his answers, like always, focusing on the CPI inflation, which is a lagging indicator, as well as the employment numbers, which is a lagging indicator, they're going to be late. They're going to be very, very late. But, I mean, that's what history shows us. All right. Netflix, right now it's in bearish trend. What happened with Besant today? I don't know. What happened with him? I've been watching this instead of the news. So let's take a look. What's interesting is that the target rate probabilities for the September meeting just 1 month ago was only a 5% chance of them remaining paused, where they're at right now. Now, with all the data that we've been getting over the past month, it went from a 5% chance of not cutting to now a 42.7% chance of not cutting. And so this is making me remain in the camp that we're not going to be seeing any type of cuts this year at all. So tomorrow we have core PCE prices. That's the Fed's preferred inflation gauge. So we'll see what happens there. Chicago PMI, as well as job cuts. And then on Friday, we have the big one, which is unemployment rate, the actual real payroll numbers, hourly earnings, as well as ISM manufacturing PMIs. So that will be pretty interesting to see. PANW. Palo Alto. Yeah, this looks like it broke trend here. So would not be buying this. Yeah, no. Definitely not. That's myself though. Can't provide direct financial advice. All right, well everyone, that pretty much concludes it for today. I hope everyone has a fantastic rest of the day. Good luck out there, and we will catch you in tomorrow's daily macro update. Bye everyone.